Real estate or stocks? It's the most argued about question in personal finance. Real estate gurus tell you stocks are paper wealth. Stock investors tell you houses are money pits. Both can't be right. Here's exactly what the math says, with the parts most videos quietly skip. Here's the headline number nobody on YouTube wants to admit. $100,000 invested in the S&P 500 30 years ago is worth about $1.74 million today. The same $100,000 in US residential real estate at the historical average appreciation rate of 3.5%, about $280,000. That's a 6 times gap. But before you cancel your house hunt, this is only one piece of the math. Real estate has a secret weapon stocks don't have. Let's break it down. First, an important distinction most videos don't make. When people say real estate, they usually mean one of 3 very different things, with very different math. 1. Your primary home, the house you live in. This is a forced savings vehicle and a place to live, but it's not technically an investment in the usual sense. 2. Rental property. This is a real investment, where you buy a property and lease it to tenants for monthly income. This is where the leverage magic happens. 3. REITs. These are real estate companies whose stocks you can buy on the stock market. They give you real estate exposure without owning any property. 3 different categories, 3 different return profiles. Most beginner videos lump them together. We won't. Here's how they actually stack up side by side. On unleveraged returns, stocks have averaged about 10% per year over the last century. Residential real estate has averaged about 3 to 5% appreciation, depending on the source. Stocks win. On liquidity, stocks win again. You can sell stocks in seconds. Selling a property takes months and roughly 10% of the price in transaction costs. On effort, stocks win because they require zero. Real estate requires significant work, even with property managers. On minimum investment, stocks win. You can buy 1 share for less than $100. Real estate typically requires $50,000 or more for a down payment. But here's where real estate fights back. On leverage, real estate wins dramatically. Banks will give you a 30-year loan at favorable rates to buy property. They will not lend you money to buy stocks. The verdict: stocks win on simplicity for most people. Real estate wins for people willing to use leverage and put in the work. Here's that gap visualized. Watch what happens to that $100,000 over 30 years. Both start at the same place. By year 10, stocks are at $259,000. Real estate is at $141,000. By year 20, stocks have hit $673,000. Real estate just under $200,000. By year 30, stocks at $1.74 million. Real estate at $281,000. The unleveraged comparison is brutal. But, and this is critical, almost nobody buys real estate without a mortgage. That changes everything. Here's where real estate fights back. With most stock investments, your $100,000 buys exactly $100,000 of stocks. With real estate, your $100,000 as a 20% down payment buys $500,000 of property. That's 5-to-1 leverage from a 30-year mortgage. So when the property appreciates 4%, your equity isn't growing 4%. It's growing closer to 20% on your initial down payment before factoring in carrying costs. Plus, every month, your mortgage payment converts more of the loan into your equity. After 30 years, you own the entire $500,000 property outright, which is now worth around $1.6 million. Banks will lend you that kind of leverage to buy real estate. They will not do that for stocks. Leverage is real estate's actual secret weapon. So when do stocks win for most people? 4 scenarios. 1. You want truly passive investing. Stocks require zero work after the initial setup. 2. You don't want to manage property or deal with tenants. Real estate is a part-time job, whether you admit it or not. 3. You want instant diversification across hundreds of companies and industries. Real estate is concentrated in one property in one neighborhood. 4. You're investing in tax-advantaged accounts like a 401k, IRA, or Roth. These work for stocks, but not for real estate. For most regular working investors, stocks are the simpler, faster, more diversified path. But real estate genuinely beats stocks in some scenarios. 1. You're willing to use leverage and learn local markets carefully. Done right, leveraged rental real estate can match or beat stock returns. 2. You can find rental properties with above-average cash flow. In some markets, rents cover all the costs, and then some. 3. You want forced savings. Some people simply won't invest the difference if they rent. Owning a home automatically saves money each month into equity. 4. You want the tax benefits. Real estate has depreciation deductions, the 1031 exchange, and other tax shelters that stocks don't have. For people who fit these criteria, real estate isn't just competitive with stocks. It can win. 3 myths to bust before you go. Myth 1. Real estate always goes up. False. In 2008, US home prices fell about 33% over 2 years. Some markets fell more. The illusion of safety in real estate comes from the fact that you can't watch the price update every minute the way you can with stocks. Myth 2. Stocks are gambling. Also false. Over any 20-year period in modern history, the S&P 500 has never lost money. The volatility you see day to day is noise. The long-term trajectory is up. Myth 3. You have to pick one. Wrong. Most wealthy people own both. Real estate for leverage and tax benefits. Stocks for liquidity and diversification. The real answer isn't either/or. It's both in proportions that match your life. Real estate versus stocks isn't a war. They're different tools for different situations. For most people, stocks are the simpler, faster, more diversified path. For people willing to use leverage and put in the work, real estate can win. The wealthiest investors usually own both. Match the tool to your situation.